Investment in the US securities markets are subject to market risks and US regulations. Read all the related documents carefully before investing. Trading in US equities should be as per rules and regulation of RBI, FINRA and SEC.
If talking about taxes makes your head spin, we're here to help. Coinswitch Kuber has launched US stocks trading on the app. But what about taxes on these earnings? Hi, I'm Arunima and today we're going to talk about how gains from US stock trading will be taxed. Now let's get started. Congrats! You've bought your first US stock and even booked a profit. Now let's move to taxation. When you earn any amount from a US stock, there are two kinds of taxes that are at play: capital gains tax and dividend tax. Let's talk about capital gains tax first. Number 1. Capital gains tax. If you're holding US stocks, you don't need to pay US taxes. However, let's not forget Indian taxes, they're still in the picture. It depends on the time frame during which you hold your US share. If you hold them for more than 24 months, that's 2 years, then you'll be taxed 20% plus cess and surcharge. It depends on what's applicable. If you hold your investment for less than 24 months, 2 years, short-term capital gains tax will apply, and also your income will be taxed depending on where it lies in the slab rate. Number 2. Dividend tax. Sab changa se na? Now let's move on to dividend tax. A lot of times US companies pay dividends to shareholders. Yeah! These dividends from US stocks and ETFs are taxed at a flat 25% rate. The dividend that you'll get is given to you after this tax is deducted. That's one part of the story, the US angle. Let's fly back to New Delhi in India. The dividend income will also be taxed in India as well. Number 3. DTAA. Here's where DTAA or Double Taxation Avoidance Agreement comes to the rescue. Tan-ta-da! This treaty between India and the US helps balance tax liability in India against dividend tax deducted in the US. Alright, let's take a small example to understand this better. Hypothetically, a company has declared a dividend of, let's say, $50. After 25% deduction, so the tax has been removed, what you'll actually get in hand is $37.5. Lekin picture abhi baki hai dost. You can actually claim credit for the tax that was deducted. So that $12.5, that can be adjusted against the total tax payable in India. Number 4. Impact on Indian investors. Now that we've understood all of this gyan, what does this actually mean for Indian investors like you and I? There is a huge, and I'm talking massive incentive for traders to invest in US stocks. And I'm saying this despite the 25% tax on US dividends. Why? Because one gets the option to offset tax paid in the US against tax liability in India. The result? Solid returns. We hope this cleared your doubts about taxation on US stock capital gains. See you on the app. If you like this video, don't forget to like, share and subscribe.